we're going to look at chapter 4. And chapter 4 is on payroll. I want you to know from the beginning that most companies these days do payroll in, they have a software system, an HR system that does most of the payroll. But it's good to also know how to do it, like I've said with the other chapters as well. Um, and it's just nice, if you don't have the system yourself, of course, or you might, but to figure it out too, to make sure that you're getting paid correctly. And I think that that's really important too, is to understand why you're getting paid what you have paid, and some of the things that are coming out and why they're coming out. So we're going to talk about all that in this chapter on payroll. I want to let you know there are different tax tables depending on the state, the years, all those kinds of things. I did attach, and in your chapter 4 module, you do have some tax tables that I would like you to use for these exercises, for these assignments. If you use a different tax table, the answers won't come out right. And so you'll wonder, oh, why is my answer wrong? Because hopefully all that part is fixed, so everything will be right. But yeah, if you don't use these, they won't be correct. This one happens to be from 2020, and it also is Kansas. And I know it's like, why choose Kansas? Well, Kansas has a state income tax and Alaska doesn't. So it was kind of a, pick one that had the state so we could, work on that too. And so that you would know how to do it if you work at a company that has people from other states, and you need to think about those tax applications, or if you live in another state besides Alaska now, or if you plan to move to another state in the future, that you will be aware of that. So yes, make sure it is attached. Make sure you're using these tables as we go along. Make sure you use the correct table. Because even if you have the calculations right, if you use the wrong table, then it won't come out right. So there are different tables and your exercises, and when we go through these, we'll talk about the different things, the different tables, and just be careful. Like table 1 is weekly, table 2 is bi-weekly, and we're going to get into that and show you how your dollar amounts, your salary that you get, your paychecks will be different based on how you file. And you probably have noticed in the last few years too that they've changed the way that the W-4 is done. And used to be, we were able to claim deductions. So you were able to put like married and to on your W-4, and they would pull out based on that. That doesn't work that way anymore. So you have to, put married, but then it doesn't figure out the same. So those are little things with the taxes. I don't know all the tax rules. All the tax laws. I don't pretend to be an accountant because I'm not, but I can tell you, a little bit about, the overview, and from a payroll standpoint as well. So again, anytime you need anything, you need some help, please let me know. But we're going to go through this. We're just going to go through the chapter like we usually do, and give you some examples. So the first section is 4.1, salaries and wages. So we are going to look at, there's some different terms related to salary and wages that we're going to look at. We have gross earnings, and that's the total earnings made before taxes and deductions are subtracted. We are going to look at the 4 common methods. We're going to look at salary and hourly wages and commission and piecework as the different types. Typically, we talk about salary, and we'll get into a little bit of this further along too. If a person has a set rate that they make every week, typically that person would be considered exempt from the Fair Labor Standards Act, which you can look into if you want to a little bit more. I dealt with it a lot when I worked in human resources, but the salary is, a fixed amount. You're exempt from FLSA, which is the Fair Labor Standards Act. If you're non-exempt, that means you're covered by that act, and you are able to work overtime and get paid for overtime, as opposed to just working, and just getting a set amount. So, and it's a good thing to make sure if you are correct as exempt or non-exempt. Another topic, another discussion, another class, but it's important really to know the difference if you have questions about it. So we are going to look at salary. There are different intervals that you can get paid, and depending on the interval, would depend on what it's going to look like. So as we go down in here, let's see, example 1, Meredith, a teacher, receives a salary of $38,400 a year. So she doesn't get paid for overtime, which, I don't know, teachers should, I don't know, but they're exempt. So assuming she is paid, we're going to look at if she's paid monthly, if she's going to look paid semi-monthly, weekly, and bi-weekly, and what the differences are going to look like. So if she's paid monthly, she's going to receive 12 paychecks a year, right? So with that, we would take her gross, which is $38,400 per year, divided by 12, and so her gross pay should be $3,200. Every paycheck she gets would be $3,200 gross before we take out all the other stuff that we're going to talk about as we go along. If you're paid semi-monthly, you would get paychecks twice a month or 24 times a year. And for that, you would divide the 38.4 by 24, and she would get $1,600 a paycheck. See, it is the same, because if you do the math, 16 times 2, she's still getting that same $3,200 a month. It's just being split up into 2. If you're paid weekly, then you're looking at 52 times a year, because there are 52 weeks in the year. So with that, you would divide it by 52, and you're going to get approximately 738.46. Again, with the rounding, there will be rounding. Try to round at the very end. Keep as many numbers as you can until the very final. But because we're dealing with dollars and cents, of course, you're going to want the 2 decimal places after the decimal. If you're paid bi-weekly, that's 26 times per year. So then we have this dollar figure right here, 1476.92. Okay. There's some back and forth. You have leap years and all those kinds of things, and so that can, sometimes mess with, the way the salary and everything works. But this is the typical. We're looking at 52 and 26 pay periods. Again, just make sure you're dividing by the appropriate number of pay periods per year. So, example 2. Miguel earns $670 per week. So this is a little different. Before we were talking about the annual and we were going the other way. So this way, we want to know the equivalent monthly salary. So 4 weeks is 28 days, plus or minus, or plus sometimes. We can't multiply his weekly salary by 4. Um, so we would have to change it to an hourly first, then back into a monthly. So it kind of gets a little crazy there, but so you multiply by 52 because we're talking about the weeks. Then you're going to divide by the 12, and you're going to get the 2903.33 a month. So that's how you would figure out that way. When we get to the hourly wage, which is the non-exempt people from the FLSA, you get a fixed rate of pay for each hour when you're hourly. So to find the gross earnings per paycheck, you would take the number of hours you worked times that dollar amount that is your hourly rate. And then overtime is typically time and a half for overtime hours. So, and that's typically over 40 hours in a week. But some companies have it different. Some companies have more than 8 hours in a day. So we're going to look at some examples of those as well. And companies can make the decision whether to, they have to at least do the time and a half with the overtime if their employees are non-exempt from FLSA, but they can make it even better. So they might have like a night shift that has 2 times the regular wage. So then that's a different one. So just little things to keep in mind. Maybe that would be for manufacturing, possibly. So let's look at these. Now think about these too, because look at the numbers and look what they're asking for. Because, typically we think 40 hours a week, and then you get overtime over that. But sometimes that's not the case. So we're going to find some coming up that's not the case. But the first one is we don't have overtime. We have Jasmine, who earns $10.55 per hour, and she worked 36 hours and 45 minutes. So we want to know her gross earnings. This 45 minutes, remember, is not 0.45. If you look at it, you would take the 45 divided by 60, which is actually 3/4 of an hour, which is 0.75. So make sure that you use the 0.75 instead of the 0.45. So 36.75 times $10.55 gives us a rounded approximate of 387.71. So those were her gross earnings last week. Again, it just says make sure that you kind of a trick, not really. If it was like 15 minutes, it would be 0.25. 30 minutes would be 0.5. So those are just some different examples of what could be used on those. Let's see. Then we have a time and a half. This one is a little bit easier because it's for all hours over 40. So that doesn't have you doing another step, but you have 47 hours last week. She earns $12.35 per hour, with time and a half paid for all hours over 40. So when we look at it, her regular hours are 40 times that $12.35. So that gives her regular pay. But how many hours did she have over the 40? That would have been 47. So we take the 7 hours and we will calculate it on the time and a half. In this example, it says 7 times 1.5 times 12.35. You could also say 12.35 divided by 2 and get that answer and add those, and then there's your amount. More steps, but if that's easier for you, you can do that. That's how I usually do it. I would say the 1235 divided by 2. And so that would give me, let's actually figure it out, 1235 divided by 2, because it's not on there, is 6.175. Remember, we're kind of keeping that for right now. And then we add that to the 1235. So her overtime wages are $18 and about 53 cents approximately. And then we can multiply that by 7 and we get the same amount that is there. It's the 129.675. We add those two amounts together and we are looking at a gross earnings for Jana of $623.68 once we round it. Okay, yeah, this just talks about, making sure where the rounding is. And I think we've talked about that a little bit before about making sure, especially if you're talking about payroll, because, you're charging the company. I mean, the company is paying for this. And so if you're off, they could be way off. And that could happen, especially when you're calculating like increases and things like that. So next example. Okay, this one is the 8 hours per day would be the overtime. So Pete earns $14.78 per hour, with time and a half paid for all hours over 8 per day. So we want to find his gross earnings for this week if his schedule was this following schedule. So we look at this and we say, okay, we would figure out how many hours are over 8 in a day, and we have 3. So we know that's 1 here, 1 on Wednesday, 2 on Thursday, and 2 on Friday. So that's 5, right? And then what is the rest of them added up would be 38. So we've got 38 times 14.78, which gives the regular pay. And then we've got 5 hours at his overtime rate, which would give us the 110.85, which would give us the rate of $672.49. Okay, so we're going to do another one. We're going to look at, so this is different, because we have different, companies have different policies. But what if a company is not going to do the standard, which is 40 hours worked, and then anything over 40 hours would be time and a half? They need to make sure that they're at least giving the employee that much money, because if not, they are, essentially not following the law as that is concerned. So we're going to find gross earnings if overtime is paid on over 40 hours a week and over 8 hours a week. So we do the calculations. We did the 40 hours a week, which Ben would have made, was actually worth 48. And so he would get overtime. But in Kathy's situation, she would not. She would just get her straight pay and get $656. And so Ben would be making more than Kathy. In the case of 8 hours a day, Kathy would get a little bit of overtime, but Ben does not. But look at the difference in the salaries, or in the the dollar amount for what their gross earnings. For if it was 40 hours a week and the overtime over it, Ben is making $852.80. But if we do over 8 hours per day, he's got $787.20. So that's a big difference. I mean, that's, $80 somewhere around, so we have to look at what makes sense and what follows the law for the Fair Labor Standards Act. And this goes into a little bit, we've talked about that the Fair Labor Standards Act, and you can look more into it if you would like to. So hopefully that section was that it was hopefully was very understandable, and we've got gross based on regular time and overtime. Next, we're going to talk about commission and piecework. So sometimes people are paid differently than based on their hours. For example, salespeople, a lot of them work off a commission. Some of them work off of a salary plus a commission. Some work on just a commission. And so we need to look at how these people would be paid. So we're going to go into commission first, and then we'll do the piecework after. So the first example, Xavier receives an 8% commission on his net sales. If he sold $28,000 in merchandise during the last month, what were his gross earnings? So we would say 8% of that $28,000 is $2,240. So that would be his gross earnings for last month. So some people get, that's a fixed one. Some people get variable, and so it gets a little bit more sticky, but it clearly lays it out, and we'll go through that too. So if Lola is paid according to the following scale, she gets 4% on the first $5,000. She gets 6% on the next $7,000, and she gets 9% on anything exceeding $12,000. So her sales were $25,537. So we want to find out her commission. So she does not earn 9% on all of her sales, but only on that portion that was beyond her first $12,000. So to figure that out, we just subtract. So we subtract the $12,000 from the $25,537, and we get $13,537. That's the amount that she's going to get the 9% on. The rest of it, she's going to get either the 4% or the 6%. So we have 4% times 5,000, 6% times the 7,000, and 9% times the 13,537. So her total would be 1838.33. You would think that would be easy enough. Now, what happens if a customer returns a product? What if they decide they don't want it after all? And there's going to be returns on it. And sometimes, in some cases, the salesperson loses out on that sale because they didn't have it anymore. So that needs to be taken into consideration too. So if we look at this example that Terry earns 8% commission on the first 7,000 and 12% on his net sales over the first 7,000. We want to find his commission when he sold $12,255 of merchandise and had $472 in returns. So basically, it's like he didn't get that total because he had to subtract that 472, right? So we're going to look at based on 11,783, which is that 472 subtracted from that 12,255 of his original sales. So when we look at it, we say the first 7,000 was for the 8%, and the next would be under the 12, and so we add that, and we get his commission. So the next one is going to be, I talked about wage plus commission or salary plus commission, and so sometimes depending on, the type of sales a person is in, or, if it's slow, then companies will incentivize salespeople by giving them a base rate too, until either sales pick up, or, so they could keep them until they're making more money. Not everybody does it that way. I several, like, if you sell cars, then typically that is just a straight commission and they don't add the wage. I have seen where, um, if there is a product that somebody is selling that it, it takes a long time to get through the process from the uh, going through the negotiation and then signing the contract and then getting paid. That's especially like for government, people that sell to the government. Sometimes they will look at that and give a person a wage early, knowing that they're going to get that. And I saw that when I was working in human resources for uh, it was called Exabyte. It was a backup facility. It was a high tech. I don't know. It was back in the 2000s. But anyway, we had different types of salespeople that were responsible for different types of products, or, different industries, or for the government. And so we had to have different plans based on who they were selling to and when they would expect to get paid, technically. So let's see. We are going to look at this salary plus commission. So Isabella earns $11.25 per hour. She gets 5% commission on her sales. So last week she worked 35 hours and she sold $59.70 in goods. So we want to find her earnings. So the first thing we will do is we will take that 35 hours she worked times her rate of $11.25, and that will get her total of $393.75. Plus, we want to take into consideration her commission, which would be the $59.70 for the goods she sold. We will multiply that by 5%, or 0.05, and get $298.50. So her earnings for the week are those two figures added together, which give us $692.25. All right, let's try another one. They get more difficult, of course. We're adding on. Now she earns a salary of $580 per week. She gets a 3% commission on her sales. Last week she sold $15,866, but she had $924 in returns. So we have to deduct that. So we look at it and we say, okay, her sales were $15,866 minus the $924. So that ends up being $14,942. So then we multiply that by the 3% commission and get the $448.26. We already know what her salary is, because this one, thank goodness, they did not ask us to figure out the weekly salary based on her wage. So it's already there. So your amount is $1,028.26 when you add those two figures together. So that is commission. Now we're going to talk about piecework. So this is common in like a manufacturing setting, where people are paid based on how much they produce, not the dollar value, which would be commission, but like on every widget, for example, that they sell. Thinking about the other one that they make. So we look at it that way. So for example 6, Brittany works in the shipping department filing orders. She earns $1.30 for each box packed. if she packed 375 boxes this week, what were her earnings? So we're just going to multiply the 375 times the 1.30 that she gets per box, and she would make $487.50 for her work for that week. Yeah, pretty simple. Yeah. Then we get differential piecework, and sometimes that gets a little bit more involved. Just like commission can get a little bit involved. But let's look at it and let's see what we can do. So in example 7, John sews shirts at a garment factory. His weekly piecework rate is 34 cents per shirt for the first 1,500 shirts and 41 cents for each additional shirt. So last week he sewed 1,825 shirts. That's a lot of shirts. What were his earnings? So the first 1,500, we are going to multiply by that 34 cents because that's how much he gets on that first amount. And so that gives us $510. And then we look at the additional. So if we subtract the 1,825, the 1,500 from the 1,825, we get 325. And so you multiply that by the 41 cents and you get the amount that he earned. So we also have, just like the salespeople, if somebody returns something, sometimes companies will charge or take out pay if something is defective, like if they didn't do it right. And they can't, of course, because they can't use them. So we're going to look at this example. Kathy assembles electrical switches she gets $1.65 per each switch. Yes, switch. Sorry. And she is charged back 95 cents if it's defective. So last week she produced 358 switches, and 11 of those were defective. So how we would figure that out is that we have the 358 times the $1.65 she gets per switch, and we get that amount. But we also know that she has to pay back, essentially. She never gets it and then has to give it back. It's more of, they take it out beforehand. So there was 11 of those, and they charge her 95 cents for each one of those that she messes up or that doesn't work. So that you subtract the $10.45 that you get, and then that's her pay for the week. So that is piecework. So remember that when you're calculating commission involving sales returns, when we looked up there in examples 3 and 5, the amount of the returns was deducted from the total sales first before multiplying the commission percentage. But when we calculate piecework, the chargeback is deducted at the end after calculating the piecework. So it's a little bit different, so just keep that in mind, depending on whether you're looking at commission or piecework. So now we get into ways that we don't get our gross earnings. So we're getting to our net earnings. So in this, we are looking at the taxes, and we are looking at FICA and FUTA. FICA and FUTA. Okay. So we're going to talk about how we get rid of those from your pay. Technically, that's what it is. So FICA is the Federal Insurance Contribution Act. When we look at FICA, we are talking about Social Security. They also call that Old Age Survivors and Disability Act. And Medicare, which they also call hospital insurance. And then also there can be supplemental medical insurance and additional Medicare tax. So we're going to look at those in these questions. We're going to use this, rate that we have in the book for our assignments. So we're going to look at Social Security being 6.2% of the first 137,700 of gross wages. We're also going to look at Medicare being 1.45% of all gross wages, and additional Medicare at 0.9% if you make over $200,000. So we're going to deduct all these wonderful things. Another thing that we need to think about that we will get to in our exercises, because it will ask you how much that the company owes for an employee for the week or the paycheck or whatever. So we have to consider the fact that employers are also paying matching shares of Social Security and Medicare. And so what happens is that the employee's portion and the employer's portion are submitted to the Social Security Administration and Medicare, so that they can make sure that the two taxes are taken care of. So basic Medicare is truly a flat tax. The Social Security tax has a wage ceiling. And then we have the additional Medicare tax. It has a floor. So we will look at that, the floor, because it's over $200,000. So we're going to look at some examples. So Brenda has had $1,186 in gross earnings, and her prior cumulative earnings were $116,582. How much will be deducted from her current paycheck for FICA taxes? Now, why do we need to know her prior cumulative earnings? Well, that's because as we looked up here, the Social Security is based on the first 137,700 of gross wages, but not over, and the additional Medicare is on gross wages over 200,000. So you're not always charged all of those. It just depends on where you're at. So we have the sum of 116,582 plus 1,186, which gives us 117,768. So we know that that does not exceed the 137,000 ceiling. Therefore, we're going to tax all of our current earnings at the rates given above. So we're not taxing the whole amount, including the prior cumulative earnings. We're pulling that back out. We just needed to know that to determine what the tax is going to be. So make sure that you take that back out when you're doing your calculation. So if we did the Social Security computation, we would say 1,186 times that 6.2%. And remember, as we saw in fundamentals, we move the decimal point over to the left, it's 0.062, and we get that the Social Security taken out would be $73.53. Then the Medicare computation would be the 1,186 times the 1.45%, and that's on the whole thing, so we don't have to look at the portion, and that's $17.20. So since her earnings are below $200,000, she would not owe the additional Medicare tax. So her Social Security would be $73.52, and the Medicare would be $17.20. And those amount also the employer would match. So when we get to a question that asks about how much the employer's cost would be, make sure we add those to their cost. We're subtracting it from the employee because it's coming off of their gross wages, but we're adding it to how much the employer is responsible for each pay period. So here's another example. Chelsea has gross earnings of $2,852, and her prior cumulative earnings were $136,896. You see where this is going? How much will be deducted for FICA taxes for this pay period? So if we add the $136,896 plus her current, which is $2,852, we're getting $139,748. So what was that magic number? It was $137,700. So that was the ceiling. So only the portion of the current earnings below the $137,000 can be taxed for Social Security. So we want to subtract that amount from the $137,000, and we get $804. So it's only $804 that we're looking at for the percentage of the Social Security tax. And then the Medicare, it stays the same because there's no ceiling or cap or anything. So we're looking at 41.35. So those are the two amounts that would be taken out of Chelsea's paycheck and that the employer would have to cover or match. So let's do another example. Danielle had gross earnings of $30,472 for current and had prior cumulative earnings of $198,427. That's getting pretty high up there, right? So what was that ceiling? It was 200,000. So I think we're going to have to do another one, right? So her prior cumulative earnings exceed the Social Security wage ceiling of $137,700. So her current wages are not subject to Social Security tax, but all of her current earnings are taxed for Medicare. So she did go above. She's already paid everything into Social Security that she needs to for the year based on her salary. So all we are doing on this one is we're doing the multiplication for the Medicare, which is 50.34. But we also have to think again about the fact that the additional Medicare, and we saw that way up there, but anyway, over 200,000 had a 0.9% that we would need to add and essentially subtract from her wages. So we're looking at the $50.34 and the $17.09 would be what would be deducted from her paycheck. Example 4, she has gross earnings of $32.51 and had prior cumulative of $212,655. All right. So we know it's above the $137,700. Her current earnings aren't subject to Social Security, remember, because she's paid all of it into Social Security that she needs to. But all of her current earnings are taxed for Medicare. So we are looking at the $32.51 times the 0.0145 and getting that amount. And again, her earnings are over $200,000. So we're taking that times the 0.09, and we are also deducting that additional Medicare tax for her. So, yeah. If you're self-employed, it's a little bit different. There are different numbers and different things that you have to look at. So, for example, in 2020, the self-employed tax rates were what is listed below. And again, you see that there is the first $137,700. They also talk about a amount between that and the $200,000, and then the 3.8. So basically, when you're self-employed, you're paying the employee and the employer share. So that's why it's higher. But there's also this little neat thing that self-employed people can get, that it's kind of like they can take part of it as a business expense. So that's where it doesn't end up being the full, 12.4 plus, all the ones added together. You get a little bit of a discount on that. So if Mike is self-employed and has $34,533 in earnings for the first quarter, how much will he owe in self-employment tax? So we're reducing the earnings by 7.65%. Remember, that was the amount that was the difference between with the discount, with the being able to claim it on their taxes. So if we reduce the earnings, and that's how we do it on these, we reduce the earnings by 7.65%, meaning that the person is only taxed on 92.35%. And so he or she would be taxed on this amount, the 31,891, as opposed to the total 34,533. So in essence, it's like lowering the amount that they earn, because it's tax deductible on that portion. So you're only paying tax on a portion of it. So then we get that dollar amount and we multiply it by that 0.153 or 15.3%, and we get that amount. And that is self-employment. Then that was FICA. Now we have to look at FUTA. And FUTA is the Federal Unemployment Tax Act. So of course we have taxes. We're paying unemployment taxes, and it can differ depending on and they call it the experience rating, and that's just if there are jobs that have a higher percentage of employees or ex-employees that typically get benefits, unemployment benefits, then they have to pay at a higher rate than they would if it was like a one that's not considered. Now this FUTA and SUTA is not a tax that is paid by employees. So we are not deducting these from the employee's amount for the net pay, but we are adding it to the responsibility of the employer. So we kind of want to look at you have to pay both, but the FUTA rate is based on the 2020. Again, we're basing on the 2020, not the same. The rate is 6.0% of the first $7,000 of each employee's gross earnings in a year. However, if the state has a high state unemployment rate, which is at least 5.4%, then they are entitled to a 5.4% credit toward their FUTA taxes. So, since we're looking at Kansas, the highest state rate in Kansas is greater than 5.4%, so a credit would be available to, hold on just a second, would be available to those employees as I wait and get this to go back on. But so we are looking at the paid on the first 14,000 of employees' gross wages, and the FUTA for our examples in the book are 0.6% of the first 7,000. So Going back to FICA and FUTA. I hit the wrong button again, of course. Let's see, where are we? Oops, that's the self-employment tax. We did that one. Okay, there we go. Okay, so let's look at our first example. Joe Murphy's last biweekly gross earnings were $1,895. His previous cumulative income was $5,750. His employer has a state unemployment tax rate of 2.7% on the first $14,000. Find his employer's federal and state unemployment tax liability. So, we first need to look at the cumulative. They give it to us, so you probably need to use it if they give it to you in the problem. But the previous cumulative income plus the current income. And we find that in this case it's $7,645, which is higher than the $7,000 earnings ceiling for the federal unemployment tax, but not the $14,000 earnings ceiling for the state unemployment tax. So we look at the 7,000 minus the 5,750, so it's 1,250 that we're having to pay on. So it's the 1,250 times the 0.006, which gives us the $7.50. And then the state unemployment tax computation would be based on that 2.7%. And so that would be the $51.17. So the employer would be paying $7.50 in federal and $51.17 in state unemployment tax. Okay. Now we've got a grouping of employees. So we want to know how much this company, which is Sunflower Doodads, has to pay in for the FUTA taxes. And so we just go through the whole thing as we did from the other ones. We're just doing it 3 times. So you're looking at the current plus the prior. In Earl's case, it's 76.54, and it does exceed the 7,000. So we would figure it out based on that, which is 28.68. Take that 0.006 and get the 17.21. So then we would look at Janet's rate, and we would look at Samuel's rate. And when we look at Samuel's rate, Samuel made his first $14,000 previously. So none of his earnings are SUTA taxable. Okay, so make sure you look at that. Some of them they won't have. Because he's already, the employee's already covered all of that for the state employment tax. And then you would compute the state unemployment, which is what you're getting the total right there. And then that's the amount, the tax amounts for FUTA and SUTA. So federal unemployment tax and state unemployment tax, but SUTA and FUTA. So withholding for income tax. This is when we're going to get into these handy dandy little tables. So we've had federal income tax for a long time now, since 1913. But we have federal withholding taxes, and there's also state withholding taxes if it's a state that is that takes out for that. And so again, we are looking at Kansas because they do have the state. So the amount of withholding tax is based on the gross earnings, the filing status, the number of dependents, the length of the payroll period, and the method used for computation. So the first four are used to kind of make everything a little fairer than if for everybody, as opposed to some people having to pay larger or smaller based on um, their wages. So we look at the categories of single or married filing separately, married filing jointly, and head of household. So when you're filling out your W-4 form, you are putting those in there. As I had said before, prior to 2020, you were able to put your allowances on there. And that's not the case anymore. It's just put on to the tax return when you do the tax return. So we will look at that, and then the state of Kansas actually does do that still on theirs. It's a K4. Different states have the different numbers for it, but the federal government is the W4 for all of that. So when we're doing this, we're going to look at these rates, and I showed you these tables before as we go along to figure out these calculations. So this is just one way that it's filled out, that it's done. Again, if you're doing your own taxes or you're an accountant and you're doing it by hand, then you will need to make sure you are using the correct form and not doing the wrong one, because then you wouldn't get it right. So for example, if you look at this table 2, and it can look a little confusing, but we need to make sure that we are looking at the right line items. And another thing that we need to think about is that we have to read these from right to left, as opposed to left to right, which is our normal way in English that we do things. Okay, so we want to use the gross earnings and find the correct table, okay, the correct bracket. We want to use the rule provided in the table to compute the tentative withholding amount. And remember, it's always from right to left. Then we are going to, if there is a dependent child tax credit, we're going to look at another chart and get that information. And then we're going to subtract that, if there are dependent children, from the amount we get. So if you look at this chart right here, I'm just going to kind of explain it. So married filing jointly, this is a biweekly payroll period. If the amount of wages is this certain amount, but not over this, the amount of income tax to withhold is this, of the excess over this column, the last column, okay, the last column. I was pointing at the columns. I know you didn't see that. Sorry. So first we look at what bracket. So for example, if they fall within the 857 to 2020, so it's over $857, but not over 2020, then we're going to do that rule right here. So anything in excess of $857, we're going to multiply 12% for withholding, and then add $38. So for example, if the person's wages were $860, then 860 minus 857 would be $3. So you're only paying $3 times the 12% plus the $38. Okay, so again, we're looking at where they're falling in that. So again, using the gross earnings, use the rule provided to compute the tentative withholding, and we look at the tax credit if we have dependent children, and then we subtract that. So this is the little box that looks as the dependent child tax credit, and that's also in your appendix, and that's attached in your module for this week. So hopefully you saw that. But these are the same amounts. These are the amounts we're using because these are the 2020 ones, which we're using for this example. So during 2020, Albert, a married filing jointly, was paid $21.65 biweekly. On his W-4 form, he claims 2 children under the age of 17. So we want to compute the federal withholding tax. So first we want to look at married filing jointly. So we're going to go to the table and, we got married filing jointly. But we also see that he is being paid biweekly. So we want to make sure that we use the correct table, and that's this one. This would be table 2 because this is married filing jointly biweekly. Okay, so if you go over on this line, and he was at $21.65, so you want to make sure you get the right line. So we're going to use this line that says over 2020 but not over 3766, $177.56 plus 22% of the excess over 2020. So remember, we're going from right to left, right? So how much is his pay over 2020? So we say 2165 minus 2020, it's $145. So we're only doing the percentage and computing the percentage on that $145. So that gives 145 times 0.22 is 3190. Then we're continuing. We did that part, and then we did the part about the 22%. We go to the next part, and it's plus $177.56. So we know that the tentative amount so far, we're not done, is $209.46. So now, if we know that he's getting a biweekly salary and it's going to remain the same for all 26 of his paychecks, we can calculate the annual salary off of that. And we know that when we do that, we get 2165 times 26, because when they're biweekly, we have to do the 26. And his rate is $56,290, which is less than the amount that for claiming dependents. So he's able to claim dependents. So now we want to figure out how much he can also subtract, how much, so that he would have less tax to be responsible for based on the number of children that he has. So if we go back to the first page, the federal dependent child tax credit values for 2020, and we make sure we look at the fact that he's the biweekly, and that's $76.92 per child. We have 2. So we're multiplying that to get $153.84. Then we subtract that from the amount we got prior from the other table. And so then we get $55.62. So that's the amount of Albert's federal withholding tax deduction. So there's that example. Your second example, he's single and he has no children. and he was paid $3,746.65 semi-monthly during 2020. So we're doing basically the same thing. We will be looking at a different chart because it says semi-monthly. So we need to go and look for the semi-monthly, which would be table 3 is the semi-monthly. And we need to look at the correct table or bracket. And so he is single. So we look at the top left one, and he is 3746. So we're looking at the table that says over 3,660, but not over 4,578. And then we keep reading to the right, and we see that we are going to have to we're going to have to do those calculations for that amount. So first, we are going to look at what is the excess over 3660, and we find that that's 8665, and so we're doing the 32% off of that, so that gives you the 2773. So then it says to add $693.12. So far, the withholdings are $720.85. And he doesn't have any dependents, so that's it on that one. That's it. We have another example. This one is weekly, and she's had a household. So you're looking at another chart again. So just make sure you're looking at the right one. You're going through the same steps. Go from right to left. 684 minus that 684.80 minus the 315. So you're basing that percentage or multiplying that percentage by that excess, which is 369.80, and you're getting that amount, the 44.38, and then adding the 1360. We don't have any. Yes, we do. Yes, we do. We do have dependents. She's got 30, but she's doing the head of household, so that was a little bit different table. So we look at, first we have to figure out what her annual salary would be to make sure it's not over $200,000 for claiming dependents when an employee is filing as head of household. See, this is different because remember it was $400,000 before when we looked at when he was married filing. I think it was married filing jointly, but it's that way for married filing jointly. So each dependent child has a tax credit value of $38.46. So that is based on the chart again, and we're looking at weekly. So that's where we get that amount. We multiply 38.46 times the 3, and we get the 115.38. So we're already looking at the tentative amount is $57.98. So 115.38 is bigger. So we're actually looking at a negative for her tentative withholding amount. So basically, when we say that, it's zero. There's not withholding in that case. So state withholding tax. That was federal. State withholding tax. States do it differently. Alaska does not have one. Kansas does. We're going to look at Kansas as of 2020. So we're going to look at the filing statuses for theirs. And they have single or married, and then they have the number of allowances as well. And that's this little chart at the bottom of the first page on the withholding tax tables right there. So the employees' withholding allowances are subtracted from the gross income before finding the appropriate tax table and calculating the tax. So just make sure that you're doing the way it's telling you to make sure, because if you don't, you'll get the wrong answer. So here we go. Kara earned $22.35 for the last 2 weeks. She's single and claims 2 allowances. Find her state of Kansas withholding tax. So this one is pretty straightforward. Each state of Kansas withholding allowance when an employee is paid bi-weekly is $86.54, which is on the little chart. And she's got 2, so we multiply that by 2. Then we subtract, which is the $22.35 minus the $173. So now we are looking at her that she's taxable on the $2,061.92. So it puts her in a different tax bracket. And so then we look at the tax bracket, which make sure that you're not looking at federal for this. Make sure you're looking at state, because it's going to be a different one. So we look at table, let's see, she's looking at bi-weekly, and she's single, so we're looking at 2A for the single person. So we find that she is in the 5.7% tax bracket. So we are doing the same thing again. We're talking it from right to left. So if it's the excess of $1,269, so we subtract the $1,269 from the $2,061.92, and we get the $792.92, and then we multiply the 5.7% that we see on the chart by that, and we get that amount. And then we go further to the left, and it says plus $48.17. $93.37 would be her withheld for state withholding taxes. So that was federal, that was state. After taxes. So basically what this is is saying that depending on the type of program we're looking at, the tax we're looking at, some things are deducted before taxes and some are after taxes. So we need to make sure that we're looking at that too when we are making the deductions, because it could be based on the net earnings as opposed to the gross. So for example, Gina is married, filing jointly, claims 3 dependent children. For federal, claims 5 allowances for state, and earned $2,533 on her last weekly check. Her prior cumulative earnings were $4,987. The unemployment rate is 2.7 on the first 14, and we want to find her net pay. So we just go through the steps like we've done before. We would look at the tax table, make sure we have the right one, do the subtraction, do the multiplication of the 24% on this case, and add the excess. Then we've got the 3 dependent children. So she gets that amount. She gets the $333.52 for them. Or no, she gets the, sorry, excuse me, I went too fast. She gets $115.38 for the 3 dependent children. And we are subtracting that amount from the $488.90 that we got before, which was her tentative withholding, to get the withholding based on with her 3 children, which would be the $333.52. And then we're going to look at the state withholding. And on the state withholding, it looks like she's claiming 5 allowances for the state. So when we look at the state allowance values, it would be weekly, 43.27 times that 5 is $216.35. So once we subtract that, we know that that's the amount. The 2316.65 is what's taxable out of that. Then we look at our tables, make sure we have the right tables, do our calculations on those, do the addition on that. Then we look at Social Security tax, and we just like we talked about before, we're just doing all of these in one problem, so it's all adding them all up. We look at, make sure the Social Security tax based on remember the 137,700. So we have to make sure that the cumulative earnings and her current earnings do not go in excess of that, or we need to make consideration for that. And then we also calculate that Medicare tax, which is 1.45%. And she has deductions, if you add those all up, $333.52 for federal, 106.23 for state, $157.05 for Social Security, and $36.73 for Medicare. And then we subtract all that from the gross pay to get her net pay. And then that's your answer. So, kind of a lot of steps. But just take it step by step and work through the problems, and just make sure you're looking at the right tables, and you'll get this. You'll get it. Remember that I talked about how much an employee is responsible for employing a person each week. So that's where we get into making sure that we are doing these calculations correctly too, because we don't want the employer to have some violations of the laws based on paying the Social Security and the Medicare. So we know that the percentage is the same. So we look at the 2533 times the 0.62, which gives the 157.05, and then we look at the 141.45%, and we get that amount. We are looking again at the cumulative earnings and her tax earnings for that. She has not earned her first $14,000, so we need to put it in for state employment tax. So the taxes that Nelson Automotive would be paying would be the $157 for the Social Security, the $36.73 for the Medicare, the $12.08 for the federal unemployment tax, and $68.39 for the state employment tax. Now remember, the $157.05 for Social Security and $36.73 for Medicare will be the same amount that Gina is actually paying as well. But remember, the employer has the same responsibility for Social Security and Medicare that the employee does. So we're adding all those, and we're actually adding that to her gross pay, because that's the amount that they would be responsible for. So we're adding the Social Security, the Medicare, the federal unemployment tax, and the state unemployment tax, and we're getting the $274.25 in taxes that the employer would have to pay. So on top of the gross, which is $25.33, plus those taxes, the employer would be responsible for $2,807.25 to employ Gina for this week. Next, we want to know the effective tax rate, right? One more step, one more thing to do. So If we look at Gina's 2533 gross salary, she paid $333.52 in withholding for the federal income tax, because we're looking at the federal withholding tax rate. We're going to use the PBR. Remember, we used the PBR before, um, not the professional bull riders. But we're gonna try to find the rate, and so we're going to say P divided by B. So because P is the part, and that's the 333.52 over the 25.2533, and we find out that the rate for the federal income tax is 13.17%, which is a little different than what we got. So that's the effective tax rate, which is different than the marginal tax rate, different from the bracket. Okay, but it depends on what we're looking at. So we need to make sure what they're asking for and what we're going to give on that. So we want to look back at the tax calculations from example 1, and we want to find her effective tax rate. So we went through that, just going through those, putting those numbers in, and we get 25.01. And that's it for this chapter. We're done. Now it's time to do your chapter 4 exercises. So I hope that you that this was helpful to you, and that it kind of helped to explain things as going along. And remember to continue to reach out to me if you have any questions or problems or anything like that on this, because I'm here to help you. So thank you, and see you next time.